For most people, taxes feel like a penalty. It's just this bill you get and you have to pay it. But what if I told you that the moment you understand how the system really works, the whole game changes? You can actually stop playing defense and, well, start playing to win. So let's just reframe this for a second. Is the tax code really something designed to punish you? Or is it just a set of rules? A rule book with built-in incentives that you can actually learn to use to your advantage? Let's dive into that. See, the government uses the tax code to guide what we do with our money. It's not just about them collecting cash. It's this incredibly powerful tool they use to reward certain activities. Things like creating jobs, providing housing, or investing in new technology. The key thing to get is that at its core, this is an incentive system. And this quote right here, it just hits the nail on the head. It's all about a mindset shift. It's not just about what you earn, it's about how your finances are structured. It's about moving from being a passive taxpayer who just reacts to a bill to being a proactive business owner who's actually playing by the rules of the game. Okay, let's get into the first, most fundamental rule for anyone who's serious about their business. You absolutely must create a clear, legal line in the sand between you, the person, and your business, the entity. And that clear line, it starts right here with something called an employer identification number, or an EIN. Honestly, the easiest way to think about it is like a social security number, but for your business. This is the very first official step to making your company a real separate thing in the eyes of the IRS and the banks. Now, these 3 steps look super simple, right? But failing to do this is one of the most common and, believe me, costly mistakes that new business owners make. Step 1, get the EIN. Step 2, use that number to open a dedicated business bank account. And step 3, and this is huge, run every single dollar related to the business through that account. This financial separation is absolutely non-negotiable, which brings us to why that separation is so critical. Mixing your personal and business money is called commingling. And if you do this, you risk what's called piercing the corporate veil. That basically just destroys the legal liability protection your LLC is supposed to give you. It puts your personal assets, your house, your car, your savings, at risk if the business ever gets sued. All right, so now that you've created that separation, the next strategic move is to choose your business structure. And listen, this isn't just some legal formality on a piece of paper. This choice directly controls how the money your business makes is actually taxed. And that brings us to a really core concept of this whole tax game. This system treats different kinds of income very, very differently. Understanding the distinctions between these buckets of income is the absolute key to building an effective strategy. So here's the breakdown. You've got ordinary income, which is usually from your active work, and it gets hit the hardest with stuff like self-employment tax. Then there's passive income, maybe from a rental property you own but don't manage day to day. And finally, portfolio income from investments. The goal really is to legally and strategically control which of these buckets your money flows into. This is exactly where structure becomes strategy. By default, with a standard LLC, every single dollar of profit is considered ordinary income, so it gets slammed with that self-employment tax. But, and here's the move, you can file a simple election with the IRS to have your LLC taxed as an S-corporation. This lets you pay yourself a reasonable salary, and only that salary is subject to payroll taxes. Any profit left over, you can take that as a distribution, which is not subject to that same tax. So let's put some real numbers to this. On $100,000 of profit, making that one simple S-Corp election could save you over $9,500 in a single year. This isn't some shady loophole. It's about understanding and using the rules that the system itself provides. Okay, let's talk about the tools the system gives you to lower your score. And by score, I mean your taxable income. See, business expenses aren't just costs. They are government-sanctioned deductions, and they're designed to encourage you to reinvest in your own business. The rule of thumb from the IRS is that you can deduct expenses that are ordinary and necessary for your business. Now, that's a deliberately broad definition. It can cover everything from a portion of your home office in your car, to the software you use, and even the fees you pay to accountants and lawyers. So for something like using your car for business, you've got a strategic choice to make. The standard mileage rate is super simple to track, but the actual expense method, well, it requires detailed records of gas, insurance, maintenance, but it often leads to a much bigger deduction, especially for newer or more expensive cars. It's a classic trade-off, convenience versus optimization. Now check this out. Here's an advanced play that's built right into the tax code. The system has these special incentives for buying heavier vehicles for business use. Rules like Section 179 are a form of what's called accelerated depreciation, and they can allow you to deduct a huge chunk, sometimes even the entire cost of the vehicle in the very first year you buy it, instead of having to spread it out over time. So far, we've focused on the annual income game, but the tax code also gives us a framework for long-term wealth. Let's shift gears a bit and look at how assets can be protected and passed on, often without ever triggering a big tax bill. This three-step process is an incredibly powerful way to preserve wealth. First, you buy an asset that goes up in value, like real estate or stocks. Second, instead of selling it and paying capital gains tax on the profit, you borrow against its value. That gives you tax-free cash to live on. Finally, when you pass away, the asset goes to your heirs. And here's the magic trick. Their cost basis gets stepped up to whatever its current market value is. This means that decades of built-up capital gains can be completely erased for tax purposes. Now, you might be thinking this is just a strategy for the ultra-rich, but federal estate taxes don't even kick in until an estate is worth many, many millions of dollars. So, for a lot of families, this buy, borrow, die strategy is actually a very real, very viable plan for preserving generational wealth. You know, understanding all these individual strategies is powerful, but to really grasp the game, you have to zoom out and see the entire board. Let's take a look at the bigger picture of how this whole system is funded and really why it operates the way it does. If you look at recent data, you can see that the vast majority of government funding, a whopping 84% combined, comes directly from individual income and payroll taxes. That slice of the pie from corporate taxes, it's way, way smaller. This really shows you who's carrying the primary load for funding the government. And this leads to the larger economic reality we're in. The government consistently spends more than it brings in. This creates this kind of perpetual cycle of borrowing new money just to pay off old debt, all while continuing to spend more than it makes. Understanding this is key to understanding why the tax code is designed to so heavily incentivize private investment. That's the engine that grows the whole economy, and ultimately the tax base. So to bring it all home, the tax code isn't random or trying to be mean. It is a carefully designed system of incentives. It's built to reward those who create jobs, provide housing, and invest in the economy. It rewards structure and it rewards proactive, strategic thinking. So, we've just walked through the operator's manual. We've seen the rules, the strategies, and the real incentives behind them all. This system isn't going away. So the only question left is, now that you understand the rules, how are you going to choose to play the game?